Welcome back to this little accounting series I'm making. My name is Taylor, and as you can tell, I've changed my hair, I've changed my background, and I'm ready to talk about accrual versus cash basis. Have you ever looked at your bank account and thought, wow, I have so much money, only to realize that after food, rent, and utilities, you only have about $20 left? Whether you realize it or not, you're probably using cash basis accounting. The formal definition of cash basis accounting is a method of accounting in which we record revenues upon the receipt of payment. This is a single entry system, meaning we only keep records of transactions that involve cash. But what if I told you that instead of just tracking the inflows and outflows of cash, you could actually predict how much you're going to have by the end of the month? Oh my gosh, I know, right? That's where accrual basis comes in, and it's primarily what we're going to use in financial accounting. Accrual basis accounting is an accounting method where revenues and expenses are recognized when they occur, rather than when cash is received. It's a dual entry system, which is pretty cool because it means we can keep track of tons of things that aren't cash, like accounts receivable, land, property, equipment, revenues, expenses, liabilities. I mean, the list just goes on and on. In order to use accrual basis accounting, you have to follow this thing called the revenue recognition principle. Okay, pause. I'm gonna be real with you. There's a few things you should know about accrual basis accounting before we get into the assumptions and principles. First off, in the US, we use the Generally Accepted Accounting Principles, or GAAP, which is recognized by the US Securities and Exchange Commission as the standards for financial reporting in the US. Other countries use something called the International Financial Reporting Standards, or IFRS. No matter what you use, the point is you can't just make your financial statements based on whatever you feel like. There's rules that you have to follow, and in the US, that's GAAP. There's also more than just the one principle I'm going to be talking about in this video. Under GAAP, there's actually 10 principles and assumptions you have to know, and if you want me to cover those in a later video, I definitely will. But today, we're just going to focus on this one, because it's pretty important. The revenue recognition principle states that revenues and expenses are recorded in the period in which they're earned, not necessarily when cash is transferred. One important thing to note is that revenues are income sourced from your business activities, and they're part of your owner's equity. As I mentioned before, accrual basis accounting is a dual entry system, which means that every transaction is going to have at least 2 entries. Not to get too into debits and credits, although if you want to, I'll go ahead and link the video I made on it. But if I were to record the sale of a service, I would go ahead and debit whatever was given to me in exchange for the service, such as accounts receivable, and I would credit service revenue. The same goes for expenses. Let's look at an example. Say I'm a contractor and I edit people's books before they send them out to publishers. One of my clients can't pay me until a month after I edit their book. The whole point of making financial reports is to give my investors an accurate picture of my company's finances. So if I were to wait to record the revenue from my service until I received cash, I would be understating my assets on my reports. On a small scale, this may not seem like a big deal, but remember that corporations are dealing with millions of dollars of revenue each year. If they don't report their revenues in the same period in which they're earned, they're going to wind up lying about how many customers they had or how much they spent on the services they provided. Not only is that going to get bad when investors get involved, but it's going to become a really sticky situation when they're filing their taxes and they're underreporting their assets. Not to get into tax law, but it's never good to understate your assets. Don't get me wrong, you still need to track the inflow and outflow of cash. So we create the statement of cash flows. If you want to learn more about that, I'm sure I'll link the video once I actually make it. To summarize, cash basis accounting is a method of accounting in which we record revenues and expenses upon the exchange of cash. Accrual basis accounting is a method where we record revenues and expenses when they are earned, and it's based on the revenue recognition principle, which comes from the US Generally Accepted Accounting Principles. That's all for this video. Good luck studying, and I'll see you in the next one.